I am Gabriel Penagos, Professor of Finance in the Department of Economics at Pontificia Universidad Javeriana, Bogotá, Colombia, and this is the module of financial markets. The access to the financial market is allowed by financial institutions, which are corporations that deal directly with investors, should they be individuals or firms. They provide intermediation services, borrowing from lenders to lend to borrowers, hence the name of financial intermediaries. Financial intermediaries can be classified as either depository institutions or non-depository institutions. The former are institutions legally permitted to collect public funds, for example, banks. Their liabilities are deposits. Non-depository institutions do not accept deposits. An example might be companies that establish contracts to invest in securities in return for some benefit to the client. One instance of this are insurance companies, which receive premiums to compensate for risks, and mutual funds, which accept funds for the public and invest in securities, like stocks or bonds. Financial institutions serve the economy in various ways. One of the most critical functions is to provide liquidity to the market by creating suitable assets and liabilities. Liquid assets can be easily transformed into cash at reasonable prices. Maturity transformations provide liquidity to banks. Banks accept short-term deposits and lend long-term loans. The reason this works is that with many depositors, the inflows cancel out the outflows, leading to a small net flow. The outflows can be covered by few liquid assets. As the assets are large, if carefully programmed, they will mature regularly, providing extra funds to comply with net outflows and reducing the liquid reserve. Whenever a negotiation takes place, whether for a good or a service, there is some form of expense associated, the transaction costs. Those might be the time spent to find a counterparty or the monetary cost involved to carry the negotiation out. Also, the time and resources needed to assess the counterparty's creditworthiness must be taken into account. Financial institutions connect savers with lenders, reducing costs. And because banks screen their clients, risk is reduced. This leads to lower interest rates being charged. Risk diversification is another function of financial intermediaries. Risk arises when there is a possibility that outcomes may vary. This doesn't necessarily mean that they are disadvantageous, simply that they are unexpected. Financial institutions invest a large pool of resources collected from its clients into a heterogeneous group of securities, diversifying each individual portfolio. This could be done individually because of the cost and time required. Buying a large amount of an asset has roughly the same cost as buying a small quantity, hence the per unit transaction cost diminished. Financial institutions have specialized managers devoted to researching the market to find the best securities to invest in, further reducing risks. Reduced transaction costs contribute to liquidity. Direct lending or buying a bond incurs contract costs. Moreover, if you are interested in diversifying your portfolio, there are commissions to be paid for each security bought. These transaction costs are reduced through financial institutions because of economies of scale. Having a large pool of clients means that a bank can set standard contracts and reduce search costs. The price for the service of intermediation comes from the difference between the interest rate charged to borrowers and the rate paid to lenders, that is, depositors. Financial institutions pool short-term resources from clients to transform them into long-term loans. They grant access to the financial system through networks, as well as carry out bookkeeping that tracks the financial lives of their customers and provides liquidity. Two problems associated with asymmetric information are adverse selection and moral hazard. Adverse selection occurs before the transaction is completed and arises as a result of the lender's lack of information on the borrower's trustworthiness. The solution involves information disclosure, government disclosure requirements, and private information services. Collateral is something of value pledged by a borrower to the lender. In the event of default, it backs or secures the loan. If a loan is unsecured, on the other hand, a high interest rate is charged for it. Net worth is the owner's stake in the firm, the value of the firm's assets minus the value of its liabilities. It serves the same purpose as collateral, since the lender can make a claim against the company's net worth in case of default. Moral hazard, however, takes place after the transaction. We can observe people's actions and can ascertain whether a poor outcome was intentional or the result of bad luck. The lender knows little of how borrower's funds will be used and the effort that will go into the project. Again, this situation can be overcome with information. Financial institutions collect information inexpensively about the clients and the market, reducing the effects of adverse selection and moral hazard. Screening loan applicants reduces adverse selection. Monitoring borrowers and enforcing contracts deals with moral hazard.